after his.
Give us a second. Let me introduce you to this distinguished crowd of colleagues, Nina, if I may. Dear colleagues, welcome aboard, welcome home, welcome to another exciting episode in the saga, let's say, on KHAS lectures on global political economy. Today, we are hosting a very distinguished, honored colleague, Annina Kaltenbrunner, Nina, as we know her. Is a professor of global economy at Leeds University Business School, also PhD from SOAS, that is the School of Oriental and African Studies. And Nina will talk us today on international financial subordination in the age of asset manager capitalism. Nina, many thanks for being with us along with colleagues. The floor is yours.
Thank you very much. Well, thank you so much for having me, and thanks so much for the invitation. And if I have a bit of time at the end, I will tell everybody how important role you've played for me, Erinj, but I do that later. I get through my presentation first. So thank you so much for having me. Oops. Yes, so Erinj has already introduced the title. It's a joint paper with Bruno Bonizzi from the University of Hertfordshire, one of my trusted and very much productive causes. And it's a paper which is currently under review for a special issue in Environment and Planning A on the question of asset manager capitalism. So with this paper, we have responded explicitly to a certain call and a certain literature on asset manager capitalism, which I will introduce. And it's a paper which is in the second stage of revisions. We got very tough revisions. We completely rewrote the paper. And that's in a way the first time I'm presenting the rewritten version of this paper. So any comments will be very useful and very much appreciated. So maybe to give you a bit of background to the paper and maybe to highlight its main contributions right from the beginning is so that the empirical background to it is that we have seen globally in global financial markets a rise of large asset managers as keynotes of financial intermediation. So over the last, probably since the global financial crises, big mega banks or too big to fail mega banks have been slowly replaced by these big asset managers as keynotes of financial intermediation or keynotes as key in financial intermediaries. And probably the best well-known ones are the big three, BlackRock, Vanguard, and State Street. And when I teach this, I show my students the size of these asset managers, which at times have really exceeded and have exceeded the GDP of smaller countries, probably even including Austria, where I'm from. And so this kind of rise of asset managers of key financial intermediaries has gone together with, on the one hand, also the increased role of passive investment strategy and the increasing role of index providers. So rather than kind of taking active portfolio decisions on assets, very often these large asset managers use indices where they track a specific index, so where investors track a specific index, which includes countries at a certain share, and passively try to follow that index rather than taking active position, let's say on Turkey or on Brazil or on South Africa, etc., etc. And with that, of course, the replacement of banks by these large asset managers has also come the move to, if we want, so institutional transformations towards more market-based financial systems. So the rise of exchanges, the rise of financial assets, and also the rise of collateral-based financial relations, as, for example, the work of Daniela Gabor has been showing. And all of these developments have been summarized as a process, or even, and we can argue, and we will probably, as you will see, disagree in our paper about that, a new stage of capitalism, which is now driven by a new stage of financial capitalism, which is now driven by asset managers. In the form of asset manager capitalism, going back to the work particularly of Benjamin Brown, but also partly Brett Christophers, who has been co-editing this special issue for Environment and Planning and has recently written a book on asset managers. So what then the question our paper is to ask, well, what role does asset management have? Oh, hello. Do you want to say anything? No.
I don't think so. Yes, thank you.
I don't think that was addressed to us, but to me. So what that paper then does, it tries to, ask the question, well, what is the role of asset manager capitalism in emerging markets? So on the one hand, there is the empirical observation that indeed in these countries, they are becoming more important as well, and I will show data on that. But at the same time, we lack a systematic conceptual and empirical analysis of how this, asset manager capitalism both impacts, but also potentially manifests very differently in these kind of different specific spaces, and particularly subordinate or countries or spaces characterized by the subordinate position in the global financial and monetary markets. And I'll come back to what I mean with that. So what that paper then does on a broader level, or the broader contribution of that paper, is to bring together the literature on asset manager capitalism and the literature on international financial subordination to investigate, on the one hand, to what extent the main propositions or implications of asset manager capitalism hold outside the UK and hold in this subordinate monetary and financial spaces. And then at the same time, to what extent the specific configuration of asset manager capitalism in those economies interacts, affects, or potentially reinforces their their international financial and monetary subordination. So to kind of look at this bidirectional relationship between asset manager capitalism and international financial subordination. So what I want to do in this paper is first to give a very brief review of the literature. And what we are then doing is we're looking at what we think are three of the main implications of that asset manager capitalism affects and cements that same subordination. And very broadly, but I will come back to them in more detail, these three implications are, on the one hand, the potential of asset managers to reduce the instability of financial markets and provide more patient long-term capital to these financial markets, and also in the context of emerging markets, reduce external vulnerability. The second implications is the relationship to what Benjamin calls extensive financial accumulation. So it's the process that rather than generating or increasing finance through generating returns or interest rates, really the main goal of asset managers is to increase assets under management, and hence contribute to the increase of financial assets more generally. Some of them could, some people we could describe this as financialization, although we have referees pushing back against that. And finally, the third implication is to how asset managers exert their power, their structural power in the global economy. And the argument there is that rather than doing that through exit, in the Hirschmanian terms, they're doing that through voice. So they could potentially, because of their importance, influence both governance and macroeconomic policy making through an active exercise of voice, so as shareholders in companies or directly on governments. So these are the three implications which we're looking at in the context of the subordinate economies. But let's have a look at the literature first and define some of these terms. First of all, the literature on international financial subordination, where I and many others have been working on recently. And we have recently published some more conceptual theoretical papers where we basically propose this concept of international financial subordination, which characterizes what we call the structural and systemic nature of emerging markets' subordinate position in international financial and money and financial markets. And with structure, we mean that this subordination is not the outcome of some misaligned policies, as the mainstream would argue, but is fundamentally the result of their subordinate integration into both hierarchic production market characterized by global value chains and unequal relationships in global value chains, and the subordinate integration into global financial markets characterized by a hierarchic international monetary system where the dollar sits on the top, so currency hierarchy, and financial asymmetries where financial operations are centered in advanced economies, and particularly financial centers in those advanced economies, Washington and New York and London as the main financial centers. And so that's structure, but it's also systemic in the sense that the subordination is not a byproduct, but it's actually an inherent feature of financialized capitalism, and crucial to facilitate the creation, transfer, storage, and realization of value on the global scale. So this is an argument which particularly Jeff Powell has been developing, and together with Bruno and myself. And then finally, the way this subordination and manifests, we shall argue, is both as a constraint on agency, and there's quite a bit of literature which looks at particularly the constraint on macroeconomic agency coming out of the currency hierarchy literature, but also persistent value transfer from the periphery or from these emerging capitalist economies to the core. For example, as in the value transfer through global value chains, but also through higher interest rates and higher financial payments. So that's the background, or that's the literature on international financial subordination. Why within that literature there have been some recent contributions which look at the rise of new financial actors and changes in financial markets, particularly institutional investors and pension funds. There isn't really in that literature yet a systematic engagement with that rise of asset managers, or potentially even a new form of capitalism in this form of these large asset managers. At the same time, then, as I've already introduced, this asset manager capitalism literature, chiefly developed by Benjamin Brown in the context of the US and in the context of corporate governance and corporate markets, where the key argument of Ben is to say that because these asset managers have become so big, they've become true universal owners, and they're so exposed to US economies, both in terms of their spread, but also in terms of their depth. So they are involved in so many companies and also have such a large exposure to these companies that actually structural exit from these companies isn't possible anymore. So they have become so embedded into these economies, into these companies, that actually structure, that the exercise of structural power through exit just isn't open to them anymore. And as I've said, so in addition to this large and a deep exposure, the key goal of these asset managers, because they're mainly financial intermediaries, these asset managers, they don't really invest on their own terms, but they take the wealth of insurance funds, pension funds, high net worth individuals, and channel and manage that wealth. They're not necessarily so much interested in making the actual financial return. So they're not so much interested in what the individual company does, but they're really interested in increasing their assets under management, and by so doing, increasing the fees and the income they're generating by that. And these two processes, so the universal ownership and the push to increase assets under management, has three important implications, or at least in our readings. It's a very young literature, but having read that literature, for us, there are three key implications, particularly also then in the context of emerging economies, as we want to point out. The first is then the question whether actually this universal ownership and this reduced threat of exit means that these asset managers could potentially stabilize financial markets, and could be a potentially positive development as compared to, for example, speculative, the macro arms of big banks or even hedge funds, etc., etc. So whether there could stabilize financial markets as true patient capital. The second implication of that, which Ben discusses in quite detail, is the shift, and I've hinted to that already, is the shift from an intensive financial accumulation, which is primarily interested in increasing returns, so high interest rates, to extensive financial accumulation, where the key goal is to increase assets under management. And as a result of that, in the context of asset manager capitalism, the implication is that we would see a push for the creation or the continuous creation of new financial assets, different types of financial assets, tradable financial assets, and the underpinning infrastructures or institutional transformations which underpin these new asset classes to allow also the trading or the liquidity to these assets. So we would see what others would have described more generally as a financialization of the economy, where we see an expansion of financial assets and new market-based forms of financial intermediation, in contrast to more bank intermediate forms of financial intermediation. And finally, as I also already hinted at, then what this literature argues is that in contrast to the structural power of exit, the way these asset managers or actors then exercise their powers is through voice. So the argument would be that because they're so powerful, because they're so important, they sit so they're key shareholders and influence corporate governance through actively influencing management strategies. Although more recently, actually, there is work coming out, and we engage with that, as you will see, is that surprisingly or unsurprisingly, those asset managers actually don't seem to influence corporate governance very much at all. And the way we see that particularly is in a context of ESG investing, where very often these asset managers don't really necessarily vote against other key shareholders or against the board, but most of the time go with the voting. Now, the explanation Ben puts forward is that this is because these asset managers have become so large and so structurally important that they're worried about the political backlash for doing so. So they're actually worried about raising too much awareness and showing how important they are because of potential regulatory political backlash against their power. We have a slightly different take because, of course, because as we will show, they're just not as important yet in emerging markets as they are, for example, in the US. So that's the literature then. On the one hand, international financial subordination, which shows this structural subordination in global financial markets. On the other hand, this literature on asset manager capitalism, which shows a potential fundamental transformation of how global financial markets work. And then the marrying of these two literatures to see, well, how do these two processes interact? So how does subordination shape asset manager capitalism? And how, on the other hand, that does the specific form of asset manager capitalism, if at all, interact with the subordinate position of emerging economies in the global financial system? Our key argument, I will go into the details, but our key argument is that actually when we look at the data so far, the exposure of asset managers to emerging markets is far too narrow and far too shallow to speak of something like asset manager capitalism comparable to what Ben identifies in the US. So asset managers have become more important, but they're still they still don't have this true universal ownership as it has been observed in the US. Our second key argument is that we have seen, yes, we have seen a rise of asset managers, and we are seeing some of these institutional transformations and move towards more market-based financial systems and the creation of new financial assets, but they come in specific forms. So they come in specific subordinate forms, which we argue actually have the potential definitely to cement, if not potentially even exacerbate, the hierarchies in the global financial system, monetary and financial. What data do we have to build our argument? And there we have done a lot more new work from the first version based on referee comments. So we use our key data source are data from emerging portfolio fund research, so EPFR asset manager flows and holdings for 23 emerging markets. So EPFR data basically is they don't represent the whole asset manager space, but they have 60 or 70% of global funds intermediated and invested into emerging markets. And we look at data for 23 emerging markets, and the way we've chosen them is basically to have chosen those countries which are included in some of the key emerging market indices, so the JP Morgan's MB and the GBIM index, to have, as a sampling principle. We complement that with Orbis data on equity ownership, particularly of the big three of emerging market companies, and we're very thankful to Gabina, can't remember her last name, I'll come to that, for sharing this data with us. And then we complement that with data from the World Federation of Exchanges, the World Bank, the IMF, the BIS, etc., etc. And then on top of that, just to get a bit more of a better sense of the underlying structures and mechanisms, and for those of you who know my work, know I like mixed method analysis, we complemented them with not many, but some key semi-structured interviews with both global and emerging market asset managers and some policymakers, particularly to get a bit better insights into the way these asset managers exercise structural power, if at all they do. So these are the data we are using. Right, then, so what are our main findings? What are our key arguments? So I'm going to look now at these three main implications of asset manager capitalism in turn: financial stability, extensive financial accumulation, and the structural power exercise through voice. So what about the argument that actually asset managers might increase financial stability through their true universal ownership and the provision of patient capital? So this is where we find that actually, so this proposition or implication of asset manager capitalism, we would argue, still doesn't hold in emerging markets because their exposure is still so narrow and shallow. Quite to the contrary, because of some of the specific characteristics of these asset managers, exacerbated by emerging market international financial subordination, it might actually be that these asset managers exacerbate financial instability and external vulnerability. And we pointed at a few channels there, and I will discuss them in detail in a bit. But basically, we argue that due to these benchmark and index following, their global investment strategies and the specific liability structures of these asset managers, they're likely, or they could potentially increase external vulnerability, and the link between emerging markets, financial markets, and the global financial cycle or global financial conditions compared to, for example, banks or asset managers. But let's have a look. So we have got some, let's have a look at the first argument. So here first we show, these data show on the left side, the two panels show the share of flows, also financial flows intermediated by asset managers. So the EPFR flow data as a share of portfolio liabilities, so total portfolio liabilities based on balance of payments data. And we can see that as a share of these total portfolio liabilities, both in the debt markets, which is the top left, and the equity market, which is the bottom left, we can show that this share of asset managers has increased quite a bit over the last 20 years or so. Yeah, and it's so and that the increase has been particularly marked for debt liabilities, and I'll come back to that. So if we look at the share of portfolio debt liabilities, asset managers in portfolio debt liabilities, we can see that increased from next to nothing in the beginning of the 2000s to nearly 25% in 2021, which is our last date, or I think actually September 2022, which is our last data point. The participation has increased less in equity liabilities, but seems to have been traditionally higher in equity liabilities. So here we're starting around 30%, and we're now around 40% of asset managers in equity liabilities. Now, if we look at that as a share of domestic financial markets, which are the right-hand side, as a share of domestic bond markets on the top and share of equity markets on the bottom, we can see that whilst there have been some increases, they're still not that important. So in the context, so in the case of bond markets, asset managers now make up around 8% of domestic bond markets, and around, also 10% of equity markets, which compare, and I've forgotten this now, but I think, I'll come back to that. I'll look at the data, but which is a much higher share in the US than in our emerging market, financial markets. More interestingly, maybe in the context of the specific argument of asset manager capitalism literature about the breadth and the depth of the exposure, we see that still remains very limited in emerging markets. So if you look on the left-hand side, is the number of so that's the number of companies asset managers invest in as a share of all listed companies. And you can see, although that varies quite a lot, whereas now asset managers, or the big three in this case, so this is based on the big three, hold or are involved in 60%, more than 60% of all listed companies in the US. their share is considerably lower in emerging markets. So in Colombia and Mexico, it's relatively high, but for example, in Romania, Indonesia, South Africa, or Egypt, they're really exposed to very, very few companies in emerging markets. What is even more interesting, what I think, is that also the depth of their exposure is much smaller. So if you look at the right panel, in the US, the big three hold on average more than 10% of equity ownership. So they're quite involved, they're quite exposed to these companies. Whereas in contrast, in emerging markets, the highest is the Czech Republic, where it's just below 5%, and then it declines quite, or then the numbers are considerably smaller in other economies. So, for example, in Turkey, the value is around 4%. So the depth of the exposure to emerging markets companies is considerably less than in the US, which means that the same, if you want, so they're not as stuck as in the US. So there's still much room to pull out, because they're still very much concentrated in a few companies, and their exposure isn't that big, so they wouldn't lose that much. So that means that one of the key arguments of that asset manager capitalism literature, just empirically, this doesn't still quite hold in emerging economies. At the same time, as I've said before, is there other features about asset managers, or the way they operate, the way they trade, the way their balance sheets are structured, that might actually mean that the exposure to emerging economies might increase financial instability or external vulnerability. And I want to go quite briefly, we can go a bit more into discussion if you want so, but I'm also aware of time. The first one is the use of passive investment strategies. So you can see that here you can see the role or the share of passive investment strategies in total asset managers flows to emerging markets. And we can see that now around in the equity market, the share of passive investment strategies is around 40%, in the bond market around 20% of total strategies, compared to nearly nothing in the 2000s. And that has also been very much confirmed in interviews. So a lot of particularly the emerging, no, actually all of them, all the global asset managers and emerging market asset managers, they all refer to how important passive investment strategies matter. And the reason why that might increase external vulnerability or financial instability is that means very often that these financial flows or investment decisions become fundamentally unrelated to what might happen in the domestic economy, but might just be related to inclusion or exclusion decisions in this index. So we have a few examples in the paper where flows, particularly, for example, I think it's definitely Argentina, and another example I think about Saudi Arabia, where they include, or the exclusion in the Argentinian case of Argentina from one of the key bond market indexes led to a fundamental drop of exposure to Argentinian assets, though the fundamentals didn't really fundamentally change very much in the Argentinian case. Which doesn't mean the Argentinian assets are risky, but that's another question. So that's one of the reasons why we think that actually asset manager exposure to emerging markets could increase financial instability. And there's also evidence that in emerging markets, they particularly crowd in very few indices, which might make this even more stronger in emerging markets than in developed economies. The second reason why, and that's particularly we found in the interviews, is the second reason why they might increase financial instability is because asset managers take a fundamental global approach. And that has actually been an increased tendency to this global approach. So asset managers don't have regional portfolios or country portfolios, but they have truly global portfolios, and they look at it from a global perspective, and they reallocate from a global perspective. And so if they need to adjust in one emerging economy, they will very often also adjust in another emerging economy, in other asset classes, just to ensure that the weighting and the portfolio allocations are still balanced. So there might be portfolio adjustments or inflows or outflows just because of global portfolio adjustment rather than because of domestic economic conditions. And then finally, the reasons why we argue is that asset manager capitalism, the rise of asset managers might lead to increased financial instability and external vulnerability is because of their specific liability structure because of these asset managers. And so So, and I think what's fundamentally important here is that in contrast to banks, which to a certain extent can create their own liabilities, asset managers remain fundamentally dependent on external market-based, very often dollar-denominated liabilities. So they, in a way, their liabilities are constituted by a fine or a kind of a stock of external wealth. These are the ultimate investors, rather than their rather than their own credit decision, which then creates liabilities, as it was in the case of the banks. And that means that asset managers are fundamentally more dependent on both global dollar conditions, because a lot of that external stock of wealth is dollar denominated, and also more dependent on ultimate investor demand. Now, that holds true for all kinds of asset manager investments, but it's arguably even more important in countries which are characterized by this international financial subordination. So we know that when there are problems in dollar markets, and I don't need to, and you in Turkey know that better than anywhere else, then those currencies lower down the hierarchy or more, will be sold first. And that's so in a way these kind of the dependence on dollar conditions, or the dependence in global dollar funding markets, is even more important for currencies or countries, the issue of those currencies further down the currency hierarchy. So that's on the monetary side. On the financial side, the reasons why the role of the ultimate investor is even more important is because of the specific role. And we can come back in the questions answer session if you're more interested in that. But it's because of the specific role emerging market assets take very often for ultimate investors, which don't form part of their core portfolio to match liabilities, but are very often part of their growth and yield portfolio. So for example, for pension funds, we have another paper with Bruno where we show that emerging markets really form part of this kind of peripheral growth portfolio, which is primarily there to generate yields, rather than the core portfolio to match liabilities. And by being in that growth portfolio, emerging market assets are, on the one hand, need to be higher yielding, but also are much more sensitive to substitutions to other higher yielding assets. Yeah. So if you're in the US, you're stuck in the US, and you're not substituting anywhere else because the US is the top of the financial and monetary hierarchy. If you're in Brazil, well, you might as well, if there are problems in Brazil, or if there are problems in emerging markets more general, you're just going to B-rated bonds in the US. So there's a much more higher substitutability between higher yielding and growth assets, which makes these assets much more sensitive to ultimate investor demand and global conditions. And I've given you a few quotes here from our interviews, where, for example, one of our interviews pointed out that very often the argument is that these asset managers bring stability because of their diversification and because they're not so embedded into local financial markets. But actually he argues that's not true, because as a local financial investor, so if you're a pension fund, he gave the Polish example, if you're a Polish pension fund, your liabilities are in zloty, so you're not really bothered what happens in global dollar funding markets. Whereas if you're a global asset manager, you truly care about what's happening in those funding markets. And then I think maybe I'll come back to it because I don't want to run out of time. We have then in the paper, we have a bit of more data analysis and principal component analysis, where we show that not only are these asset managers flows quite tightly correlated, so they really kind of herd and co-move together, but they're also quite tightly correlated to indicators of the global financial cycle, or indicators of global financial conditions, like the VIX or the dollar index. Maybe just to raise here just 2 points which we found interesting in this analysis is to show that we found that rather than the VIX, flows to emerging markets are really more sensitive to dollar conditions. So the sensitivity is higher to the dollar index, and that sensitivity is higher in the case of bond markets rather than equity markets. So debt markets seem to be, or bond flows seem to be more sensitive to global financial conditions to equity markets. And you will see in a minute why we think why that's important and why that relates to the issue of international financial subordination. Right. So why does that matter all for IFS? Just very briefly, of course, financial dependence on the global financial cycle, exchange rate instability, financial instability, further cements or undermines trust in the local currency, cements subordinate position in the global currency hierarchy. It constrains policy space because all the policymakers want to be is to try to please global financial investors rather than use macro policy to direct it to domestic economic conditions. And I don't need to tell you a lot about that because I'm sure you're much aware of that. But on the other hand, we also argue that actually the global asset manager capitalism and the infrastructures underpinning it actually not only undermine emerging market currencies through the processes which I've just highlighted, but also cement the role of the dollar at the same time. And we give a few examples. So, for example, actually, if you look at the currency denomination of asset manager flows, the dollar is exceedingly important, even more so than in any other categories of dollar dominance. So 60% of our data of the asset manager flow data which we have got is denominated in dollar compared to only 30% coming out of the US. So 60% is dollar dominated, 30% comes out of the US. So it's a very strong dollar dominance of these asset manager flows. At the same time, and again, we can go into this a bit more in the discussion, at the same time, we would argue that actually market-based financial systems more general, which underpin these asset manager investments, do lead to a segmentation of asset markets where on the one hand, we have that one safe asset, which acts as a collateral, which acts as a safe cash hoarding. In the domestic economy, very often the sovereign bond, whereas in the global economy, it's the dollar. So we know that very often collateral margin requirements for global exchanges are for dollar denominated assets. And that leads to the segmentation of asset markets and in a way exacerbates or cements the role of the dollar in the global economy. And by so doing, of course, cements also the international financial subordination of emerging economies. Right, so that's the first channel. I've got 5-10 more minutes to go and then I'm done. The second channel, I go a bit quicker on that. The second main implications of asset manager capitalism was this kind of push towards extensive accumulation, so the rise of the expansion of financial assets, and also the institutional transformations to more market-based financial systems to also guarantee the safety and the liquidity and the tradability of these assets in a process which, for example, can't remember his surnames, Koenigs and Daniela Bugeboa have referred to as the Americanization of the global financial system. So we're seeing a spread of similar institutional structures across the globes transmitted by the rise of asset managers in global financial systems. And while very slowly, and I think, for example, Turkey is probably a case in point as far as I know, is Turkey remains very much bank-based. We do generally see a slow rise in more market-based financial system and the creation of new financial assets which speak to the demands of these asset managers, and I come back to which ones they are in a minute, and those institutional transformations. I have to confess, when you look at these institutional transformations, it's a bit messy. So it's not that clear cut that all countries have liberalized their financial markets, all countries have moved to more market-based financial systems. But on the whole, in our 23 economies, which we're looking at, we can observe such a general trend. So in that sense, yes, we see this kind of extensive process of accumulation. But interestingly, it happens differently in emerging markets or in the data which we're observing. And particularly, we highlight two elements where this financialization, if you want so, is different to that in for example, the US, which Benjamin Brown looks at. The first way we find it differs is that rather than equity markets, so in asset manager capitalism is very much about equity markets. In emerging markets, the ones we are looking at, on average, this expansion seems to be, or the asset manager exposure seems to be more to debt markets rather than equity markets. Now, yeah, I come back to that. And the second thing we observe is, and I think this is probably one of our most interesting results, is that rather than characterized by a broad-based expansion of financial assets and a broad-based exposure to companies in emerging markets, actually asset manager exposure remains very, very concentrated. And it remains very concentrated in the largest firms, and it remains very concentrated in specific sector. And here we were flabbergasted. We didn't expect this, but in the majority of the 23 economies, actually asset manager exposure to the financial sector, the financial and real estate sector, is the sector which asset managers are most exposed to compared to anything, independent of the economic structure. Yeah. So in that sense, we would argue, yes, extensive accumulation is happening, but it's happening in a specific subordinate form. It's driven by debt markets rather than equity markets, and it's very concentrated in the largest firms and in specific sectors. And again, I've got a bit of data to show. Maybe I leave this here for the moment, but these data show the expansion of domestic capital markets in our 3 emerging markets. On the left hand, you can see it as a share of GDP. On the right hand, you can see it as a share of bank lending. And the dotted line is the stock markets, and the solid line is the bond markets. And you can see that clearly as a share of GDP, capital markets have increased. So there is financial markets are growing. The picture is a bit less clear-cut when it comes to as a share of bank lending. So whether we see a substitution away from bank intermediation to market-based intermediation. Here we would see, so actually the dotted line, so the stock markets, is not that clear whether really it becomes more important than bank intermediation. Arguably, bond debt markets are. So if you look at the solid line on the right-hand side, we can see that debt market, so financial intermediation through debt market, is now more or less equal the size of those by bank intermediation, which is, if you compare it to the early 2000s, which is substantially bigger. So debt markets seem to have increased. And there's also been, so market-based systems have increased, and there are also new financial asset classes being created. So in most, for example, in most economies which we look at, except Argentina and I think the Czech Republic, they now offer exchange-traded funds, so ETFs. We have also seen a substantial increase in ESG assets as a new asset class demanded by asset managers. And we have seen, although, as I said, slightly less, not as clear-cut and a bit more variegated, but we have seen a general move towards more market-based institutional forms and adherence to global governance standards, regulatory standards, etc., just to adhere with the demands by global asset managers. Importantly, and I will come back to that in our last point, the way these, or if you want to, the mechanisms through which this implementation is happening is not so much through direct pressure from asset managers, because they if you want to, they have a preference for that, but it very comes through the criteria which need to be fulfilled to be included in some of the key assets being traded by those asset managers, particularly by these indices, passive investment strategies, which I've already discussed, and also exchange traded funds. And so as I come back to that, but in a way, the way these institutional transformations happen is not so much through the direct exercise of power, but through this kind of, in a way, more rule-based criteria which come through the new forms of asset classes which are being traded or disseminated, globally disseminated, if you want so, by these global asset managers. So that refers to the, if you want, so the expansion of financial assets, the financializations. As we said, and this is, the subordinate forms, that has been driven by debt markets. So this shows you the share of debt versus equity flows. The line is the median value for our 23 emerging markets, and the gray line is the interquartile range. So it shows you the spread. And it shows you that the share of bonds to equity flows is around 120%, and it has increased substantially since the early 2000s. So debt markets are important. Now, why does that matter? Well, it matters because at the end of the day, debt markets probably provide a safer investment for these asset managers than equity markets. First of all, they provide higher yields, as we know, compared to, for example, the US or Europe. They provide more committed yields, so they're not dependent on the performance of an underlying company. Interest payments need to be paid, not like dividends, which are performance dependent. And finally, very often they're also hedged against the exchange rate risk, particularly if they're denominated in foreign currency. Whereas, of course, equity participation always carries the currency risk, and actually we know equity returns move diametrically opposed to currency developments. So this exposure to the debt market shows that asset managers, yes, are becoming exposed to emerging markets, but in a very safe way, which in a way rolls over the risk to the issuers, to the emerging markets, rather than the investors, which is more the case in in equity markets, which is more the case in developed economies. And this kind of, in a way, demand for safe and liquid assets is also reflected in that concentration I've mentioned before. So as you can see in this data, if you look at the left side, the top 5 concentrations. So this is the percentage of the investments of the 3 big asset managers, so State Street, Vanguard, and BlackRock, to the top 5 listed, to the biggest listed companies. And you can see, for example, that in Argentina, the total investments of these 3 big asset managers to the biggest 5 companies, 95%. So all of the 95% of those total investments of these 3 big ones go to 5 companies. And in the Czech Republic, it's even 100%. In Turkey, it's 70%. So Turkey is a bit more diversified in that matter. And as I've already said, so it's not only concentrated by size of firm, but it's also concentrated by sector. So you can see the largest sector for these countries, and you can see that in a large share of these economies, the financial sector is the key destination for these investors. Now, why does it matter? Well, because again, big companies are safe, big companies are liquid, financial sector is a safe investment, and we've got some interview quotes for that. So they're kind of concentrating in those sectors. And what does that mean for IFS, or more development in general? Well, it means that so far asset managers don't provide financing for the broad-based structural transformation which we need, or the sustainable transformation which we need in many of these economies, but basically, concentrate in high-yielding, safe, and liquid assets. And we would argue that actually asset manager capitalism, or in a way the specific subordinate form of asset manager exposure or financialization, if you want so, in those economies, actually mirrors the dual productive structure in these economies. So we know that very often these economies are characterized, I guess if you go back to Latin American structuralist thinking, are characterized by a dual sector where you have a few highly competitive, internationalized global champions, very often state supported, as my friend Elif argues in the case of Turkey. And those are the ones which actually do get involved in global financial markets, where all the remaining rest, the small and medium-sized enterprises, remain very much bank dependent and very much finance constrained, because we also know banks don't really lend to them either. And asset manager capitalism doesn't really change anything of that. We also have an argument that these new financial assets, which come with asset manager capitalism, increase the value transfer, but I'm appreciating I'm running out of time and I've taken a lot of your attention, so I'm not going to go into this. Just very briefly, what about the exercise of voice? So structure power through voice. And as Benjamin Brown has found for the US, we find with our interviews, they're limited, they're not representative, but we didn't find in any of our conversations that these asset managers would actually take any factual, if you want so, power or exercise their voice, neither on corporate governance nor in macro policy. So even in corporate governance, so particularly ESG investing, which of course is key for these asset managers, even there, they don't really directly influence the management. On the contrary, so what we argue is that actually the structure, if you want so, and that's not, we would argue, and I'm very happy to discuss this, this is not because of the political backlash in these economies, because they're too small for that, but it's actually by now because of the true structural power of these asset managers, because they literally write the rules of the game. They decide what kind of assets are being traded. They design, or they kind of are behind the indices. You know, they design the criteria which need to be fulfilled to be included in an index or an ETF. And it's those criteria then which, in a way, you know, either mean you are included or excluded. So it's a rule-based structural power, which means these asset managers don't need to exercise their voice anymore. They are writing the rules of the game, and either you comply with them, and a lot of countries do, or you don't, and then you're out of it. And we also know a lot of these countries are finance dependent, external finance dependent, so they will try to comply the rules of the game. And we have a few quotes to support that. Maybe just the first one: the policies are important, but the impact is not direct. They're just following the rules. The rules are super clear since the beginning. And if you don't fulfill your requirements, you're going to be out of the ETFs. That's it. Rules are either you're in or out. And you know, that leads to these structured institutional transformations we've seen. Interestingly, although there we don't have that many interviews, and we probably can't say that much. So there is literature which shows this increasing power of index providers, ETF providers, etc. Our interview shows that actually actually it's not just the index providers, but these asset managers also behind the scenes also influence the design of these indices. And I have a very long quote here, but I want to read it to you because I think it's really instructive. And so one interviewer argued to say that the one, I think, slightly interesting thing is that from another angle, which was the inclusion of the Gulf states. So the United Arab Emirates and Saudi, and Qatar and a couple of others. Now, strictly, this did not belong in emerging market bond indices because they're high-income countries, according to the World Bank. But JP Morgan just came in one day and said, actually, they're going in. My understanding is that that was at the request of the managers. The large money managers put JP Morgan to include these. And then the day after, because they held large amounts of Qatar and Saudi, and whatever they got, a big one of boost, because inclusion in the index made the securities more, we didn't catch that, the transcription, but more profitable. But that's a bilateral thing. That's between the clients and the index people. And the people who have the influence on index inclusion are the clients, so the asset managers. So whereas, yes, there are kind of index providers, and Johannes Petri does amazing work on these index providers and the structural power of these index providers, and we agree with them. Our results agree with that. But actually, our results go beyond that and show that very often it's actually the clients themselves which try to influence which countries are included or not, so the asset managers. And what about IFS? Well, actually, it might be that because of that rule-based nature of the structural power, it might actually be that there's a bit more room for macroeconomic policy, and there's a bit more room for central bank intervention to, prop up, particularly prop up domestic asset markets. But you're not going to fundamentally challenge the rule. So if you're thinking about something like capital controls like Argentina did, or dare you say, if you're thinking about defaulting of some of your debt to these local global asset managers, then you're getting excluded out of the game, and then they become active. So we also have some very interesting quote on the involvement of BlackRock in the Argentinian debt restructuring, where it became very clear this is when they exercise power, and that's when they exercise voice, when the rules of the games that they write get fundamentally broken. And then there are questions about the developmental impact of ESG, but I'll leave that aside. Right, so that's all for me. I'm sorry, I've spoken. They told me I have 40 to 50 minutes, so I took my time and I did speak 50 minutes, but it was good to run it through. So I think, just to summarize, we don't see asset manager capitalism to the extent that we would maybe see it in the US, but we do see a rise of asset managers in these countries, and we would argue that this rise is mediated by the subordinate position of these economies in the global economy, and probably further cements that subordination through creating high external vulnerability, in a way reducing even further reducing the availability of finance for broad-based structural change, and further embedding these economies in a rule-based, globally hierarchic international monetary system. Right, I stop here, I stop sharing, and I'm very much looking forward to any comments or reflections. Oh, Ernst, you've got a cat. Very nice. Thank
Many
you.
thanks, Nina. Very provocative, very informative talk. I leave the floor for our colleagues for any questions or comments, any interventions. The floor is yours, dear folks.
I had to go and close the window. I am in the middle of Manhattan Union Square, so there's lots of fire trucks and things like that. It's quite noisy out there.
Go ahead, Sabri.
Well, the way I got involved in finance was through a company, and we were providing data together with some risk analytics to our clients, and JP Morgan, Morgan Stanley, at that time Salomon Brothers were still in existence, were index providers. So furthermore, I was in charge of maintaining the a Canadian market index together with Dominion Securities from Canada. So the significance of indices are quite well known to me, let me put it that way. If you want to be invested in as a company, your bonds or equities, you need to find a way to get into that in these indices so that they would buy you. So I believe that is a rule setting in a sense. You have to obey the rules that they define to be included in the indices. Anyway, but my question is, given that you have looked at many of the emerging markets, you also looked at Turkey. You mentioned that the asset managers, those big asset managers, investments are skewed towards the bonds. Whereas what we observed in Turkey, that it's the other way around. It's mostly the equities in our case. Have you noticed some deviation of Turkey from other peers of us?
Shall I just respond to that, given there weren't any other questions so far? Yeah. So we have data on the individual countries on that, and so which I didn't share. So which shows the kind of Turkey. So Turkey is probably somewhere in the middle of the field. So the share of Turkey, so if you look at our data, Turkey is roughly equal. So they hold equally, the same amount of bonds as equities, maybe slightly more. The countries where, we actually initially, when we looked at this data, we wondered whether there's some kind of regional variation, because we know that particularly, my area of expertise is more in South America. So, and actually also our interviews were more concentrated in South America, just because this is where we have the context. But anyway, I knew that South America is generally more integrated through bond markets, whereas Asia is more integrated through equity markets. So we had a look whether there is a regional split or anything, but we couldn't really see anything. So the kind of the key countries where debt markets are really important are Colombia, Peru, Egypt, the United Arab Emirates, Romania, and the Czech Republic. Where it's least important is Taiwan, Korea, India, and Argentina, and Brazil, interestingly enough. So we haven't really gone so much into. So to respond to your question, to respond to your immediate question, Turkey is somewhere in between. So Turkey like kind of lies in the middle field, and according to our data, but you know they're kind of, you know, of course they're not the whole sample either. It's around equal.
My understanding, however, is that you are not looking in this study the general investments in a country. You are looking at the investments of those asset managers, big asset managers
Yeah.
from
Yeah.
the US. So that might be the reason why what I observed might differ from what you observed, given that your focus is on the bigger asset managers.
Yeah. Yeah. So if you are kind of like, so yeah, so we are really interested in what kind of asset classes, or what kind of, you know, two key asset classes are they investing in? Is it more debt and is it more bond? And so yes, we only look at these fund flows, and for them, it seems debt markets are generally more important than equity markets, and have become more important. I think this is also interesting. And if you think about, you know, going back to the finding that we found that bond markets seem to be more sensitive to the global financial cycle. So this is another result we had. You know, there might be some relationship to that, and might in a way further support the point that the increased participation of these asset managers increases the sensitivity of domestic financial markets to this global financial cycle through asset managers.
Before I leave the stage to others to ask questions, what asset managers did you look at particularly, other than the top three that you mentioned? State Street, BlackRock, right?
Yeah. So the EPFR data combines, you know, the main fund flows. So this is kind of, you know, it's fund intermediate flows. So that has the big ones, but also more general mutual funds, etc., etc. When we look, so this is the kind of the portfolio flow data we have for the equity holdings. So where we very specifically look at the participation of asset managers in the stocks or the equity of companies, there we only looked at the big three because it's data which shows you, for example, the 10 biggest investors or something, and there you can just get the biggest investors. So we didn't look at any other institutional investors there.
Okay, so many of the results, in other words, that you shared with us are essentially associated with these big three.
Yes, yeah. So the ones that when I refer specifically to company ownership, then that's data for the big three. Yeah.
Okay, thank you.
Thank you, Sabri. Thank you, Nina. Anything else? Iman,
Most likely Sinan has a question.
Sinan, would you like to go ahead? Sinan is one of our graduate students in political economy. Nina KHAS.
Hello.
Hello, Professor. Thank you so much for your so informative presentation. Actually, I must rewatch your presentation after in YouTube again. Nevertheless, I want to ask a question about political economy dimension of your presentation. As I understand, one of the main results of your study is there is a core periphery relationship in asset capitalism debates. First of all, am I wrong?
No, you're not wrong.
if I don't misunderstand, you state that mainly core capitalist countries are in asset capitalism, but periphery countries are not at the stage of asset capitalism.
Mm.
Yes,
Asset manager capitalism, you mean?
asset manager capitalism.
Yeah.
When we look at the gain of core countries, they acquired a huge wealth thanks to asset manager capitalism. On the other hand, if we ask a question about periphery countries, how can get a huge wealth as much as core countries unless they involve in asset manager capitalism, since we know that it creates huge financial vulnerabilities as well from your presentation. Is there any conflict at this point?
Sorry, so to understand, so are you asking me why are emerging markets exposing themselves to asset manager flows? Is that your question?
Please repeat, Professor. I cannot hear you.
I'm not sure I have fully understood your question. So is your question why emerging markets are becoming more embedded into this asset manager capitalism, if you want to, despite the financial instability implications?
Yes. Yes.
Yeah, that's a good question, isn't it?
Thank
you.
Well, I think there's I think there are many ways of responding to this. I think there's a political economy dimension, and I think there's maybe a more structuralist dimension. I think that the political economy dimension is that, of course, certain parts of society, both local and global, very much profit from these developments. Yeah, so some parts of society get very rich with this and have, and have an interest in having both access to global financial markets, but also having the kind of the liquidity provided by global asset managers. I think that's the political economy explanation. I think the more structuralist, balance of payments constrained answer would be that, a lot of these countries do continue to face a more or less binding foreign exchange constraints, which means some form of current foreign capital is necessary to provide the foreign exchange, for example, to buy the imports necessary for domestic production. And yeah, these flows provided are part of these foreign financial flows.
As you stated during your presentation, this case creates more dollar dependency. Am I wrong?
Yeah, no, I think I would fundamentally agree with that. I think actually these particularly market-based non-bank financial institutions, I think, some of the referees didn't quite like the argument, but I do think that it fundamentally does strengthen the role of the dollar, just because it's such a dollar-based industry as well, and because of this, this segmentation of asset markets. I need to think it through a bit more, but I have a sense, there is there is an increased demand for the ultimate safe asset, which globally is the dollar.
I wonder this since last days there is a huge debate about transition other currencies from US dollar as a global reserve. In this case, as I understand, in the near future, it's impossible actually, since financial markets creates more dollar dependency day by day.
Yeah. So I think, yes. So I think, I know there's huge debates, and I think there are quite a few people, even in the Financial Times, who are arguing that actually dollar dominance is coming to an end, the rise of the China, and, particularly it points to the increased denomination of trade, also between Russia and China in renminbi, etc., etc. And I'm not disputing that this is all happening, but I think I agree with your interpretation of my presentation that as long, as long as the global financial system remains so dollar dominated, and as long as particularly the global financial system remains so US and Western dominated, at least at that level, dollar dominance will remain, if not get strengthened. Which doesn't mean that at the same point, and we are thinking of doing a paper on that as well, which doesn't mean that we can't see an equally at the same time increased fragmentation and multi-currency systems. So that doesn't speak against, the rise of some regional arrangements, some, even, the disagreements between China and also the Middle East. But I think fundamentally, at least for global capitalism, I think the dollar will remain in the medium term the key currency. Yeah.
Thank you, Professor.
I don't think dollar is going anywhere anytime soon. It will take a while.
Yeah, I agree with that. I think the Chinese are being smart about it. I think they're slowly building, and I think, there are institutional developments going on, which we shouldn't dismiss. So I think, the increased payment systems, etc., etc. But I think, yes, as long as finance remains so Western dominated, and the key, the dominant financial institutions remain so much embedded in dollar funding markets and dollar markets, I agree.
What caught my attention in your presentation was that most of the investments these big asset managers are making in emerging markets are to the financial sectors.
Yeah.
Non-productive sectors.
Yeah.
Most likely your explanation, structural explanation, that is, we need dollars because we all have current account deficits. So we need to finance it somehow. We need those investments, and unfortunately, they are coming to non-productive sectors, and it's a sort of trap, I guess. Somehow, something more, I don't know, structurally, we need to change something. Otherwise, all these monies will continue to flow into the financial sectors of our countries, unfortunately, and that will not help the productive sectors of our economies, right?
I was actually really surprised by the strength of that result, because we're also doing a paper with Elif Karasim and Joel Rabinovich on non-financial corporations, comparing Brazil and Turkey. And basically, I think one argument we have here is that, one argument with what we found here is more is that it's traditional, at least in Brazil, traditional comparative advantage sectors, like mining and meat production and all that. Those are the ones who get financialized, and the others don't. So I think there we would have argued it's more the kind of traditional national champions, and Elif argues that in Turkey it's more the kind of state-supported ones that really kind of play in financial markets. I was really surprised to see that financials is so important, and so that they really go not in necessarily into mining or food or whatever, but they actually go to financials, which is even worse.
Yeah. Someone sent a message.
Yeah,
Very long
Nina,
one, yeah.
can you read Pınar Kahya? She apologizes for her sore throat, and she wrote the question. But if you are reading it, let's leave you alone for a moment with your thoughts.
Can you read the chat? Nina?
Yeah, I'm reading it. Yeah, I think, Pina, I agree with you. I think we had this, I think this is why I kind of started out the presentation saying that actually this paper relates to a specific special issue on asset manager capitalism. I myself are I'm very, very dubious about, identifying 25 different types of capitalism in a year. For me, we're living in financialized capitalism, full stop. And I think, I think basically, I didn't push it so much, and I don't know what to think about this, but parts of me thinks that if one of the key arguments of the asset manager, if one of the key arguments is that the qualitative difference between asset manager capitalism and other capitalism is this universal ownership and this kind of not being able to substitute between different types of assets and being stuck, and for that reason not being able to exercise exits, that cannot hold on the global level. Because this is a totally US focused argument, because as soon as you go out somewhere outside in the periphery, there is substitutability. So in that sense, that's why I'm not sure whether asset manager capitalism, are we still being recorded?
Yeah.
Yes, we are. Well, we can give a break if you want, but
no, it's fine. But if I don't want to be quoted,
but you are at the most provocative part. Please.
No, I'm not sure whether it can be a truly global concept, because I think some of the underpinning assumptions only hold in a specific US context, and by definition, cannot hold in more peripheral, wherever that is, parts of the global system.
As a follow-up on that, well, go ahead, Sabri.
Well, one last thing I would like to say, just two sentences. In all these analyses, which are quite strong in my view, I fail to see the word imperialism. Why don't you guys bring this concept to the study of whatever it is called, asset manager capitalism, financialization, globalization, all that? There is a core, and there is a concept of imperialism that has been going on. We have been discussing for centuries.
Yeah.
Centuries back, but for quite some time. Let's put it that way. But somehow that concept doesn't appear in most of the academic studies the way I see it.
Yeah, there's a practical answer, and I'm also somebody who likes conceptual clarity, and I think for me, I at the moment have chosen to work with the concept of international financial subordination. Now, in actually, and so that if you want, so that concept, so in our RIPE paper, where with our 7 million co-authors, we do specifically refer to imperialism, or to Marxist political economy imperialism, as one of the cornerstones of international financial subordination. So it's kind of in the concept, it isn't being explicitly mentioned here. I think partly because the paper is very rich already, and I don't want to kind of throw in kind of more terms.
No, I wasn't mentioning just this particular paper. The papers that I read
Yeah.
by scholars in this area and in related areas, for some reason, do not use the concept in their analysis. Even well, you probably know her quite well, Anne Pettiford, who was our first speaker actually in this series, finally used the word probably a few weeks ago, but somehow there is, maybe it's my perception, avoidance of using that term in explaining this financial subordination and financialization and globalization and all that. There is a center, there is a periphery, as you know, and there is a wealth transfer from one part of the system to the other. But somehow the concept of imperialism is not being employed in explaining these. That's what I was saying.
Yeah, I mean, I'm coming back. I think so. I don't come from a Marxist political background, so I never feel confident enough to really. So I come from a post-Keynesian monetary background, so this is where I feel at home, and this is where I know, where I feel confident making claims. But I mean, from the little I know is that imperialism for me is also related to nation states. It's the US over whatever. And I don't think what's going on here is necessarily a kind of, the US imperializing Brazil or Turkey. It's global capital. It's financial capital. But I can see you. Sinan had another kind of question.
Well, it's by the way, Sinan, Nina needs to leave that place soon, otherwise she's going
Locked in.
Yeah.
Got
Just
5 months.
last question, hocam.
Okay.
Shortly, please. After 2000 financial crisis emerges, financial engineering became highly questionable, as we remember. After last interest rate hikes of Fed and ECB and other cores and many emerging markets, a possible financial crisis case became more probable. If a new financial crisis arises, how can we evaluate the future of asset manager capitalism?
I don't know. As easy as that. I don't know, because the next financial crisis is probably gonna arise where we least expect it. I really don't know. Sorry, Sinan, I can't answer that question.
You must be tired by now.
I am tired. And also, I always, I get the impression, the next financial crisis, I kind of, unless you really kind of, unless you really study financial markets very, very in detail, it's very hard to predict where the next financial crisis is going to rise, And even those who do study financial markets are probably unable to predict where the next financial crisis arises. So,
well, a general rule is that wherever the global financial finance finds the most enjoyable, lucrative market, that's where the likely crisis will emerge. Exactly. But that's also, of course,
probably the biggest growth story in financial markets is the one where you want to look for the financial crisis.
That's right. That's exactly right. Well, folks, colleagues, thank you, Sinan. I think we will let Nina get her rest and get her out of the building in time. Many thanks, Nina, for your very interesting, very exciting, very provocative thoughts.
Thanks for having me.
Colleagues. Many thanks, Sabri, for arranging this whole event. This had been the last session of our series. And after the summer break, I'm sure we'll be coming and joining together. With regards and best wishes to all.
Bye. Thank you very much. Bye.
Bye.
Bye. Bye.